Hello, everyone, and welcome to today's Montreal Exchange Options Education webinar. My name is David Chirisono, the Marketing Director for Montreal Exchange, and I'll be your host for this session. We're excited to have you with us today to explore selling covered calls, which is a practical strategy for investors to generate income from stocks they already own. Before we begin, just a quick reminder for today's session that it's only for educational purposes, and it does not constitute as investment advice. The opinions shared are those of the presenter and not necessarily represent the views of the Montreal Exchange or its affiliates. If you'd like to continue learning after our session, we encourage you to explore our online tools, including the options calculator, trading simulator, and covered call screener, all available on the Montreal Exchange website. Also, anytime during the session, you can ask your questions through the Slido, which is just at the bottom of the screen. We'll take as many questions as we can during the Q&A portion at the end of the presentation. And finally, a replay of today's webinar will be available on the Montreal Exchange website, and we'll also email that to you as well. Now, it's my pleasure to introduce our speaker, Chris Tom, CEO and Portfolio Manager of Moat Financial. Chris brings years of experience helping investors understand and apply option strategies in their portfolio. Chris, welcome, and thank you for joining us today.
Yeah, thanks for having me. Great to be here. It's been a little while since we've done one of these together, so excited to be on here talking about covered calls. Just a bit more about myself. So, been in the business since 2008. I am the CEO and portfolio manager here at Moat Financial. I've done a number of presentations with the TMX over the last 18 years almost. Among some different designations, I am a derivatives market specialist, which is not a widely held designation in Canada. You may have seen me on BNN. I'm the host of the bi-weekly show, Know Your Options. Next episode, which, not to kill an upcoming slide, is coming up next Wednesday. And my job day to day as a portfolio manager is to work with clients, come up with strategies that make sense for them, often including options, and then we implement the day to day. And when we're doing these sessions or on Know Your Options, we're really focused on simplifying options. There can be a bit of a mystique and some overcomplication associated with options that we think keeps people from using them more. So we try to simplify it as much as we can so that people will get out there and use options more often. Next slide, please. So yeah, just a further disclaimer to make sure we're fully covering. This is not financial advice. The majority of the examples will be generic. If you are going to start implementing some of these strategies, we recommend that you make sure you have a full understanding or are talking to a professional about it. So we are licensed in BC, Alberta, Ontario, and Nova Scotia, but have clients all over the country. Next slide. So I mentioned next episode of Know Your Options on BNN is this upcoming Wednesday at 3 p.m. Eastern. We encourage everybody who has a question to call in or send an email. That helps us a little bit to make sure that we've got good flow there, and we'll keep the show going. And that's where we're talking about everything option related and taking viewer questions, as well as coming up with a few top picks at the end of the show. So make sure you tune in every 2 weeks on BNN. So today, the meat of the presentation here is to talk about covered calls. So obviously there's a whole myriad of option strategies out there. This would be one of the most widely used and the one that is one of the easier ones to grasp that we recommend people who are managing a portfolio or have investments to really take a strong look at. So we're going to look at what are covered calls, how can I use them, and then look at, is it a good time to use them? So to go right to the beginning here, we'll take a look at what is a call option. So a call option is a little bit different than a stock in that an option is actually a contract between two parties. So you can enter into an options trade without actually having an option in your possession because it is actually a contract between one party and another. The person who buys the option, the call option, has the right but not the obligation to buy a set number of shares. So each contract is 100. By a set date, known as expiry, at a set price, which is known as the strike price. So the person who buys that has the ability to engage in that transaction of the underlying equity. but doesn't have the obligation. So that's a really big thing and what sets options apart from a futures contract. So we're going to talk about a lot of different things throughout the presentation here. And a couple of terms that will come up a couple of times will be in the money and out of the money. So the strike price, which is the right for the holder of that option to transact, is if the stock goes above that strike, then it's known as in the money, and below that strike, it's known as out of the money. So we're going to touch on this in a little bit more depth as we go through the presentation. We just wanted to get those out there as terms and the definitions ahead of time. So this presentation is about selling covered calls. So we're going to be here advocating for why somebody should sell these options. So the first question that should come to anybody's mind as well is selling them is so great. Who would buy them? Why would somebody buy a call option? So the real answer is there's a whole bunch of different reasons. But the one reason would be that they want to take a bullish position and they want to add leverage. So if you go and buy a stock, and it's say a $50 stock, you need to outlay $50. So if that stock moves up, you're participating based on a one-to-one basis of how much that stock goes up. But using an option, you can actually use a huge amount of leverage. So you can have a much smaller layout of the amount of cash that you are putting into the trade, which can have a much bigger payoff. Now, the other side of that we will discuss later is that, you're going to win a lot less often on this buying strategy versus the selling. But somebody who's just really bullish and thinks a stock can move a lot higher in a short period of time would be likely to go out there and buy a call option in order to achieve that leverage. Another reason why somebody might buy an option would be because they're bullish, but they're also worried that the stock could drop a lot. So, let's say there's an underlying stock that has, a big decision coming its way, whether it's, regulatory approval or, a discovery or something, and you think if things go right, this stock could really move a lot higher. Then you want to have exposure to that, and you can get that through an option. But the difference is that, we'll keep using that $50 example. If you buy an option on a $50 stock and spend, $3, well, if that stock falls, by a lot, your only risk is the cash that you put out there. So you can give yourself some leverage. You can give yourself the opportunity to make money if that stock moves higher, but you can limit your downside in such that you only can lose what you put into that trade when you're buying it. So that's who can be on the other side of those. Another one, a bit less common for a retail investor, would be to hedge a short position. So you're short the stock. You want to buy that option to protect yourself in case it rises. So you can buy a call option. And then a market maker. So this is who is on the other side of a lot of our trades, whether it's initiating positions or especially when we're rolling positions, it's a market maker. So these are liquidity providers that are, partnered with exchanges in order to make sure that there's a consistent bid and ask and tighter spreads, and they're providing that liquidity. So a market maker is who is on the other side of a lot of these trades. There's a lot of other reasons, and quite frankly, for us, when we're establishing these covered calls, I don't actually really care why somebody's buying it, as long as somebody is there to buy it and provide me with that liquidity. Next slide, please. So what is a covered call? So this is a situation where we own a stock. Okay, so we mentioned that a call option represents 100 shares. So in order to engage in a covered call strategy, you have to have at least 100 shares of a stock, and for it to trade in Montreal, it needs to trade on the big board of the TSX. So you've got at least 100 shares, and you say to yourself, okay, the stock is trading at X price. I'm willing to sell this stock if it goes up to X plus, Y. So let's just say we'll constantly use $50 as the example. So we've got this stock, it's trading at $50, and then we sell somebody the right to buy that stock from us at $55. And for that, they're going to pay us a premium. So they're going to take money and they're going to buy that option. And that gives them the right to engage in buying that stock at $55, which is above the current share price, by a set date. And for that, they pay us that premium, and that premium is ours to keep no matter what. This is very tax efficient income in taxable accounts. This premium that we generate is taxed as a capital gain rather than income. So this is obviously not tax advice, but that's what the textbook says. it's something that we can do over and over. We'll get way more in depth, but really we're giving somebody the opportunity to have that leverage gain, and in exchange, we're going to get paid. We're effectively, some people describe it as renting out your stock or renting out that future upside. So typically that strike price is going to be higher. So if we say the stock is 50 and we pick a number like 55 as a level that we're comfortable selling that stock, then that's where we set that strike and we do the transaction. So once you set this thing up, you sit back and you wait. You wait for those options to decay, and you wait to see what the market gives you as far as stock performance between now and when that option expires. Next slide, please. So the main reason why somebody uses covered calls is to generate additional income. So in Canada, we have seen just a massive growth in covered call ETFs. So these would be things that own a different basket of stocks and sell away some of the upside, but in exchange for that, it generates additional income. So I mentioned that these are taxed as capital gains in taxable accounts. And so it's very attractive as a method for generating additional income, especially as we enter into what appears to be another era of really low interest rates, where a lot of people can't achieve the income needs that they have within their portfolio through just income oriented GICs, government bond type investments. So number one way people use covered calls is to generate additional income. Another way is that it helps you reduce portfolio volatility. So it does that two different ways. The first way is that if I'm constantly selling a covered call and generating some additional earnings, that is going to buffer my overall position, in that if I bring in $1 and then the stock drops $1, I'm actually breaking even. So it gives me some reduced volatility in that we've got this third leg of earnings. If you look at long-only investing, one of the huge drawbacks of it is that you really only have two ways to make money. You make money from stocks going up and from dividends. So using this covered call strategy will dampen losses or increase gains by having that third silo where you're able to generate returns within a portfolio. The other way that's often overlooked when it comes to reducing volatility in a portfolio is the increased diversification in a portfolio. So many people that are income-oriented investors, they say, okay, I need to generate earnings or income from this portfolio. What do? They go out and buy a bunch of high dividend-paying stocks. So what does that do? Well, that makes them quite interest rate sensitive and often fairly correlated. If all you're doing is filling up your portfolio with banks, telecom, and pipelines, a lot of really great businesses within those sectors, but you're overlooking a lot of non-dividend paying stocks. But if you are able to generate that income on stocks that don't pay a dividend by selling these covered calls, you're able to build out a much more diversified portfolio that should have lower volatility through a broader range of markets. So that is something that's often overlooked, but is one of the biggest strengths of covered calls, is that it lets you buy a broader basket of stocks, especially if you are income oriented. One thing that, again, I think is overlooked, sometimes people say, well, you're selling away the upside, what if the stock goes up? I think this adds a different layer of discipline within your investing. So as investing professional, one of the things I've always found extremely frustrating is when analysts set a target for a stock, the stock rises to that level, and then rather than selling the stock, they just immediately raise that target higher. This will add an extra layer of discipline where if you say, okay, this stock is $50 and I'm okay selling it at 55, and you sell that 55 call, if that stock goes higher, you will be forced to sell it. So it can add a different layer of discipline rather than just saying, okay, I'm going to keep riding this even if it's gone beyond my parameters for good value in this name. So adding that extra layer of discipline that forces you to exit positions at full value. And then also, if you do have positions where you're thinking, hey, I should trim this or I should sell it, rather than just picking the day, okay, today's the day to sell this stock, you sell that covered call, and if it doesn't continue to rise, then you've generated some income and premium. But if it does continue to rise, then you will sell it. Covered calls, unlike not every option strategy is available in registered accounts, but covered calls are available in TFSAs, RRSPs, RIFs, all of these registered accounts, as well as taxable accounts where I mentioned that it does get treated in a more tax advantaged scenario. And then, yeah, I mentioned how, we can increase diversification. So I'll move on to the next slide. So covered calls, is it a good time to use them? So, typically, to be perfectly honest, we'll often find a reason to say yes to this, no matter what the market conditions. But, the reality is it is a good time. So we are seeing some good volatility in the market. I mean, it's obviously not a Canadian product, but the VIX would be the measure of volatility on the, it's a widely used, measurement of volatility on the S&P 500. That can often be quite correlated with what's happening in Canada. So as we see that VIX in the high teens, low 20s, we can be sure that we can generate some meaningful premium on a broad basket of stocks in Canada. Higher interest rates. So, rates have obviously come down, but rates are higher than they were a couple of years ago. And, not to get into the technical side of the Greeks here to confuse everybody and all that, the higher interest rates that adds value to the price of call options. So it'll weigh on the price of put options to some degree, but for the most part, if we have rates higher, then that will make call prices more expensive. And if we are sellers of them, as we are with the covered call, then we like that. So looking at the next three, volume, liquidity, and technology, all three of those things get better every single year. So there's more participants, whether it's individuals with retail or through exchange traded funds. Volumes are rising, technology is getting better that people have access to, and liquidity just continues to get better year after year. So I mentioned we were going to talk about in the money and out of the money. So here's where we'll have a look at the in the money piece. So talked about what a call option is, give somebody the right to buy a stock at a set price by a set date. And then when we look at in the money, that's how, if it's above that strike price. So now within an option price, so the cost of an option, what an option trades at, is actually called the premium. So some people will say this comes back from the insurance side of things because people can use options to insure their positions. So when we look at the premium or what an option is priced at, we need to, we can break that down into two pieces, the intrinsic value and the time value. So if we sell an out of the money option, that is all of the value within that option is time value. And that time value over the course of time is going to decay. If an option is in the money, a piece of what the option premium is actually called intrinsic. So that's just a measure of how far in the money that option actually is. So if we sell that $55 call, the stock is now trading at 56. That's $1 above that strike price. So the piece of that option's price that is intrinsic value will be $1. The time value, let's just say that option was trading at $2. Well, to decide how much that time value is we just take the price of the option and subtract the intrinsic value that is within that. Now, the time value is important because over time that decays. When we are selling covered calls, where we make our money is by selling that time value. And then we wait for these things to decay, because at expiry, whether the option is in the money or out of the money, the time value should go to zero. So this $56 example, if that's trading at $2 with $1 of intrinsic and a month to go, as we get to expiry, if that stock is sitting still at 56, as we approach the close on expiry day, that option should trade for about $1, maybe $1 plus a penny. So it's the time value and the fact that piece of it decays. That's where we make our money. So that's an important thing to make sure that you're trying to maximize the time value that you sell and not just selling more intrinsic value if you're selling something that's in the money. Next slide, please. So we'll go to, kind of parlay off that same example. So if we've got a stock that's trading at $50, okay, that's where it's currently at. And we say, okay, we're willing to sell this stock if it goes to 55. So we look out to January, that's 65 days away. Okay, so 1/6 of a year. And this is hypothetical, but this is a somewhat real world math, that if this option is trading for $1.50 and we've got 100 shares and we can sell one contract. So we've got 100 shares that are trading at $50. That's worth $5,000. And we say, okay, if this thing goes up 10%, we're okay selling it. But in order to make that commitment, somebody is going to pay us $1.50. So we'll keep moving on with this example. So day one, we're here. It's November 12th. We say, okay, we want to sell that 55 call. We look at the market. Okay, bid's 150. We sell it. It brings in $150. Okay, so it's $1.50 a share times that 100 shares. So now we've got the stock and $150, and this quasi liability where we now have made a commitment that somebody can buy that stock from us at 55 if they so choose between now and expiry. So they do have the right to exercise that option anytime between now and expiry. The reality is if it's below 55, they will not do it because why would they? They could go in the open market and buy it for 50. But as we get closer to expiry and if it gets in the money, then we start to look at could it get exercised early, and we'll touch on some reasons why that could happen. So day one, there's really not much to do. Other we do the math, we get it all set up, we do the trade, and now we wait, right? We're waiting. We've got 65 days until our commitment to sell this stock disappears. And over that time, we're going to see that option decay in value. And that's where we make our money. Every day, the value of the time value in that option will just chip away until we know that it's at zero. And then we see where the stock is at. So the maximum profit on a trade like this is $6.50. So the key thing to realize here, and I'll mention it again later, is that you do not get rich doing these trades once. It's really about the repetitive nature and doing it over and over and over. And it is amazing how these things add up after a year, 2 years, and beyond when you're just doing it over and over and over, right? You bring in $1.50 on a $50 stock, that's 3%. Not hugely exciting. But the fact that we're just selling somebody some upside that at the current moment doesn't exist, that's a really powerful thing and pretty exciting that we can go out and generate that money for ourselves. So again, I'll get back to the slide here. The maximum profit is $6.50, which is the $5 between where the stock is now and that exit price, plus the $1.50 that we collect. Mentioned earlier how this can provide some downside protection or volatility reduction. Because we had this $50 stock and we brought in $1.50, our net outlay, if we just entered the position entirely right now, is $48. So this stock could actually fall by 3% and we're breaking even. Whereas somebody who's in a long-only position, they're now down 3% from where they were. And again, this trade only lasts 2 months. So theoretically, we could do this 6 times in a year. If you did do a $1.50 trade 6 times in a year, well, that's $9. That's a meaningful return in and of itself, but we still maintain some of that upside. So mentioned that as we get closer to expiry, then we start to analyze what we need to do. So we'll take a look at what some of the choices are that we get faced with. So the outcomes at expiry, there's only 2, right? One, it's stocks either above 55 or below 55. So above 55, we have 2 choices. One, we just do nothing. We let that stock get called away. We're exited at 55 plus the $1.50. We should be pretty happy. Sometimes people will feel a bit of regret if that stock goes to $100 and now you're selling at 55. But again, as part of a disciplined investment strategy where you actually are selling stocks at certain points, sometimes that'll happen, but more often than not, you sell one of these covered calls and it will expire worthless. So if it's in the money, these options will exercise automatically. So passing through option expiry day, you go to bed on Friday night of option expiry day and the stock is in your portfolio. And Monday morning when you log in, the stock is gone and the cash is there. Another thing that we can do though is roll it to another month. So we'll have a closer look at this, but that's where we actually buy back this option that we've sold earlier and then sell a further dated one. And because that has more time in it, then it will have more time value and that will generate some additional premium. So it lets us keep the trade going even if the stock goes above. If the stock's below 55, then 2 choices as well. Like this thing is going to expire worthless. So we can just let it expire. Go to bed on the Friday of option expiry. It's in your account. You wake up in the morning on Monday and that option is gone. Your obligation to sell the stock is gone. And you drive on and look to roll it to another month or just analyze the situation, do the same process that you did at the very beginning. and look to generate more premium. Again, we're looking to do this over and over and over. Next, please. So we'll go back to the same example that so we've sold that 55 call. We got $1.50, and now here it is. It's option expiry day, and the stock is trading at 56. So if we don't do anything, this stock will get called away. And that might be our choice. That might be what we want to do. But let's just say we're thinking, okay, we want to continue to collect the dividend. We want to continue to generate premium on this. We will look at buying this back and selling one further dated. So again, the example here, if the stock's 56, it's 12 o'clock Pacific on expiry day, that thing should be able to be bought back for about $1. You take a look at the option quotes and see, all right, the 55 call out to March is trading for $3. So $2 more because it has more time. So it will have that additional time value. So we buy back the January, we sell the March. Our obligation to sell the stock at 55 remains. You can often enter these as a spread trade, which is something that we strongly recommend. Then you'll be transacting with a market maker, and it will do both trades at the same time. So it will buy back the January and sell March at the same time, or it won't do either trade at all. So you enter these and you actually put your desired credit. So in here, if we're going to buy back one for $1 and sell one for $3, we would say, all right, we want to roll this for a credit of $2. And then if a market maker is happy with that, they'll transact. And if they're not, then they won't. Now you can just lower your desired credit, to $1.99, $1.98 until somebody on the other side is willing to do it. Very, very, very important to do these as a spread trade rather than in two parts. One, because you will likely get closer to the midpoints on the bid and ask, but also you won't get one side done and not the other. So let's say you've sold the January calls against your whole position, and now you say, I'm going to roll these to March, and you sell the March. Well, now you're short January and March, and in my experience, the stock market never goes your way on these, and will immediately start getting the stock to move higher, and now you're panic buying that one back. So very important to make sure you're entering these as a spread trade in order to roll these out and just continue generating that premium. So in this example here, we got $1.50 the first time. Now we're collecting an additional $2. We're up to $3.50 in premium generated on what was a $50 stock, which is meaningful over a fairly short period of time. And then again, we just wait for the next expiry to see what to do. Next, please. So important to always, we sit here and talk about why things are so great. It's important to take a look at what some of the risks could be or what some of the potential pitfalls. This is the most important one, okay? It's not getting lured in by big premium. The market often knows more than you do. So you don't want to be sitting there and just saying, okay, look, if I sell this call, I'm going to generate 10%. It just has to, not go down over the next month. Like, that is not a way to invest. That is higher risk. That's taking a strategy that should be mitigating risk and then adding more risk. The market often knows more than you do. And so if there's really high premium on a stock, it could often mean that there's something lurking around the corner. So we always say, let's make sure you have a diversified approach where you've got some lower volatility names in the portfolio that you're doing this on, as well as a few higher ones to generate a bit more premium. But the number one thing is that you need to be working with equities that you want to own for the long term and cannot be just seeking out that high premium and then building a portfolio around that, because there will be times that works and there will be times that it doesn't. And when it doesn't, it will feel very bad. So mention, we only want to buy stocks that we're happy to own, right? We always start sort of bottom up in portfolio construction of making sure the fundamentals behind the underlying business that we're going to buy stock in is something that fits with our overall portfolio. Do your math, okay? Do not oversell. If you've got 500 shares, you can sell 5 contracts. Don't sell 10. Okay, any calls that you sell over and above the stock that you own, you are no longer covered. That would be considered a naked call, and now you are setting yourself up for the same risks associated with selling a stock short. So, the math's pretty easy. You divide by 100, you just knock a couple zeros off. So if you got 1,000 shares, you sell 10 calls, and just make sure you're not selling more than that. And then one that's not a pitfall, I would say, but some would view it as it's a bit more work, right? You sell these options, they have an expiry date. There are things that you will need to due before or at expiry in order to make sure that you're either maintaining your position or continuing to generate that premium. I think it's a good way to stay on top of your overall portfolio and have a constant review of all of your holdings. But some people don't want to do that work, and that's where, on the exchange traded fund side, you can get access to these things without that type of work. So just some additional thoughts. It's a bit of repeat on this. This comes from repetition. You don't get rich doing this once, but you will generate some very meaningful premium if you do this over and over and over. And the exercise of looking at how much premium you've generated after a year, 2 years, 3 years is very satisfying. I'll tell you, when you sell somebody a call option and that thing goes to zero, those dollars that you make are very satisfying. Take a diversified approach. So don't just have all high volatility names or just all tech names or whatever. You want to make sure you've got a mix of industry types as well as expiries. So, you don't want to just sell everything out 1 week or 1 month. You want to have some things that are expiring, a month from now, 2 months from now, and even 3 months from now. And that will prevent you from really being subject to big swings in the market affecting you negatively. If you look at, April 2020, that was the time, or April of this year, where the market dipped really hard and then came back fairly quickly. If you had sold all your options when the market was down out 1 month, you would have really sold away too much upside. So we try to take away some of that risk by having a laddered approach. And then the other one is just to be disciplined. And, if the premium is too low, don't sell it. So I think this is something I'll mention later. One of the pitfalls of some of the ETFs that are out there is that they are on sort of a program that they sell options that are X amount of the money out a month, blah, 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 and do it pretty much no matter what. We got one more slide. Yeah, so the pros and cons of some of the ETFs. Pros are that you easy access to a diversified portfolio, no ongoing maintenance. You don't have to monitor it. You just buy it and go with it. Cons, make sure you check the MER on some of these. They can be a little bit higher. I don't love some of them in that they have limited flexibility in what you own. They buy a whole basket of stocks, and maybe there's some within there that you don't want to own, and you'd rather own just the highest quality names in that space. And then the trading mandates that they just have to trade. They have to do it over and over. I think that's our last one. Yeah, so I think I went 4 minutes over, but I'm still happy with that. But hopefully we got some questions.
Thanks so much, Chris, for a great presentation. We'll open it up to questions now. I think I'll stop sharing the presentation just so that we can get full screen here. So I know you just talked about ETFs. One of the first popular questions is, do ETFs have options? Is there anything else you want to add on the ETF front?
Yeah, so ETFs, like stocks, if they meet the volume requirements and liquidity requirements, then they trade on the TSX big board, then they will have options. So I think it's important to make sure on some of these where it's an option-based ETF and then you're trying to sell options on that, sometimes the options on the options, it can make it a little bit tough. It's kind of pick one or the other, but absolutely on the bigger, more liquid names, there are definitely options.
Great. If our shares are called away, do we have to pay any additional fees?
So for that, you'd want to check with, if you're doing an online platform and you get called away, I would assume that there would be a commission that is charged on that. I don't advocate for any particular online platform. I think the rules and systems are pretty different, so you would want to do that research. For us, with our clients, our clients don't have transaction costs, so if somebody gets called away, then there is no additional fees on that.
Great. What calculation do you use to decide when to sell a covered call and let a call be called away?
So yeah, when to sell the call. I mean, again, these things, it's always dealer's choice. The thing that I love about options is that, compared to long only investing, is that you get to analyze the scenario, take a look at your opinion of a situation or a stock's value, and then you make the decision based on that. So when will we sell a call? We'll sell a call when we think something is approaching fair value or is at a level that, over an X period of time, if the stock were to rise by that amount, we'd be okay selling that stock, and then making sure that we're generating a meaningful premium on that. So, if you've got $100 stock and selling something's 10% out of the money is only going to bring in 20 cents, that's 0.2% over a couple of months. Like, you know what? We probably won't do that. But if that same scenario, we could generate, 1% or 2% over that same period, then we would likely, do that. Now, if that same stock that was 100 and we think it's worth 110, has a bad quarter and falls to $60, we're unlikely to say, okay, we can get $1.50 for the 65s, because we think that stock's worth a lot more. So it's about taking a look at your view of that stock in that moment and seeing what you can generate in a premium, and then making that investment decision on that. And then you see what the market gives you. And, getting called away on a stock, I think some people feel like some extreme internal pain that it's like, I can't believe I sold this call and now it went up and I have to sell it. Like, it's okay to sell a stock. And I think we're probably going to have an upcoming webinar talking about cash covered puts. And that's a strategy that you can employ in a situation where your stock does get called away, to still keep a little bit of action on that name or re-enter it. But I don't want to blow that whole presentation right here.
So what do you do if the stock price decreases and a covered call is in place?
Yeah, so in that, we say to ourselves, I'm glad we sold this call, because if we go back to that 50 and 55 example, if that stock is 50 and we sell that 55 call and the stock drops to 45, that option that we sold is going to expire worthless. If we sold it for $1.50, we will make $1.50 that, had we been long only, we would not have generated that premium. So as we get to expiry and that option is no longer in our account, we will reevaluate and say, okay, what does the options market look like? Something that's interesting with options is the biggest piece that makes up an options price is volatility. Now, volatility, not all volatility is created equal. So if the stock is going up 5% a day, that's volatility. But what happens to option prices? They often go down. What happens? Because people are willing to pay less for options as they move higher, whereas downside volatility will often increase the price of options. So, if we were able to generate a premium that we liked selling a 55 call when the stock was 50, but then the stock gets smoked down to $45, we might be able to generate a premium that we like out a couple of months at 52, so $7 higher, because those options will have become more expensive. So stock goes down, we say, I'm glad I sold this call. We let that option expire worthless or buy it back for a few pennies, and then we reevaluate and see if there's an opportunity to sell another one, potentially at a lower strike, or just say, hey, we're just going to hold this and wait.
Great. In your example, why did you elect to keep selling at 55, even with the stock at 56? Wouldn't you rather sell a call that is over the current price, other words, out of the money, versus selling in the money call?
So, excellent question, right? Again, I go back to, it's dealer's choice. So let's just say I've said, okay, this stock is 50 and I think it's full value. It's 25 times earnings at $55. Well, if the market takes it to 56, but my view is 55, then I will stick with that. If I can roll it and maintain that strike and generate additional premium at that level, then I'll do it, if that's where I think I want to exit that stock. But let's just say they've had great earnings and, there's the stocks things are looking better. And I or other analysts have increased our target to 60, even though I said like that, I find that annoying if it's done arbitrarily. But if things are actually looking better, we can take a look at the options market. And those spread trades that I mentioned, where you can buy back the one that you're short and sell a further one in the future, they don't have to be at the same strike. So let's just say I said, all right, I can buy back my January 56 for the dollar of intrinsic, and I can sell, a May 60 for 250. That's still going to generate some additional premium, and I move that strike up by $5. And you can enter those as spread trades as well, to say, okay, we'll buy back the 55, sell the 60 for a 150 credit, and the market maker, if it makes sense for their business and they can offset their risks, then they should do that. So again, it's up to you, and it's scenario specific based on that name and what the options market is like. Just to add to it, on higher volatility names, so where options are more expensive, you often have a better opportunity to move that strike higher. So if the piece of your portfolio that is on the higher volatility side that you're selling calls, that's where you'll likely have a better opportunity to move the strike up, potentially generate some additional premium. But on the lower volatility names, or if it's at the level that you think it's okay to sell it, then you stick with the same strike.
I'm assuming that selling a covered call works in an open account and not a registered account like an RRSP.
So if you have non-registered or registered, covered calls are allowed. They do need to be an option account. So if it's an open account, but you mean a cash account or non-registered, it would need to be an option account. In the registered accounts, not to get too technical on this stuff, you can be option level 2, which allows you to buy options long and sell covered options. In a non-registered account, you can have up to level 4, which will allow you to actually buy and sell naked options, but that's not covered calls. So you can have it in registered or non-registered. It just has to be set up as an option account, which I believe every provider should have.
Any recommended resources for research and evaluating risk?
Well, obviously, TMX, this is, where I would start. They've got a lot of tools with the option calculators and simulators, and they've got this really great webinar series that they've started here that can provide you with more information. So I would start with the TMX. There's a lot of resources out there online, many of which you do have to pay for, which, if you find something that you think is of good value, then, and it's something that you want to implement yourself, then definitely I would, pay for that. But otherwise, TMX would be good. I definitely recommend people who are going to take this seriously, even if you're not in the business, to look at the Canadian Securities Institute and signing up for the options licensing course, right? If you take the same course that industry professionals are taking in order to trade options for clients, then I think that should give you all the tools and a lot of the background and stuff that maybe isn't the most exciting, but really gives you an understanding on the math of how these things work. And then otherwise, working with a professional that has the main piece of knowledge that, they might be executing the orders or implementing the strategies day to day. And then, you can be in there as part of the kind of bigger picture, 10,000 foot, this is how I want to see it invested, but then let somebody else sort of take the reins on actually pulling the trigger on stuff.
How can we find those opportunities using Market Screener? Are there any specific criteria we can add to the screener?
I think it's just about, I guess it's having, if you're building out a portfolio and you're not just doing this on a couple of names, you're going to have a different criteria for each different name. So, if you've got some non-dividend paying resource stocks, you're going to have one criteria of wanting more upside and generating more premium. Whereas then if you've got a mix of some of the lower volatility names, then you'll have a different criteria. So for me, we look at each individual name and what our view is on the underlying. So I guess I can't really give too much advice on how to use a screener for a broad basket.
Typically, efficient selling of covered calls entails underlining great liquidity and depth. In Canadian markets, do you think these requirements are met?
So yeah, this is, I guess, one of my, I guess I've learned to love these questions because they come up so often. I think the Canadian market, both on the equity side and the option side, is getting better every year. We have more volume. We have more market participants, whether it's ETFs or retail. I think it's just important for people to realize when they are trading options that if they want to trade options on a name that has limited liquidity in the equity, the liquidity on the option just is not going to be as good. Now, that's not a Canadian or a U.S. thing. If you found a stock in the U.S. that traded 300,000 shares and then you went to a U.S. exchange, like that's going to have a wider spread and lower liquidity because that market maker will have a tougher time. So I think we do have a great mix of names within Canada that have a lot of the liquidity requirements. And I think it's just getting better. And I think it's really making sure that you are having an active approach with these names where you're not just hitting the bid or hitting the offer. You are actually having limit orders at levels that you are willing to transact at, and waiting for a market maker or another participant to transact with you. And then one last thing on the liquidity side is we talk about these spread trades. That is where you can kind of create your own liquidity, where if you've sold a covered call, say you've sold 10 contracts and a market maker is on the other side of that, and you want to roll that out into the future, if you put that in as two pieces, like you need to find either another participant or a market maker who wants to do one trade and then the other one. Whereas if you put that in as a spread trade, a market maker is able to look at that and say, look, I'm already hedging myself to negate my risk on this position for 10 calls that expire in January. I don't actually really need to change too much in order to move this out to March. So I'm happy to transact at a tighter spread, get two trades done at once. So I think making sure for your ongoing maintenance that you're kind of helping create your own liquidity and better conversation, if you want to call it that, with a market maker, will really make it a lot easier than just putting in two orders separately. But I don't work for the Montreal Exchange. Obviously, I've got a good relationship with them, but I've built an entire career on the liquidity that's available in this market, and I find I'm able to make it work, and sometimes on decent scale. So I'd say for the retail trader out there, they should be okay.
Is there a minimum expiration you're looking at before you'll trade?
No, if it makes, if we're going to have an upside, and the term I use all the time, which is a bit of an undefined term, is, meaningful premium. So if we're going to sell a call and it's going to generate what we view as meaningful premium, we don't have a minimum term. For the most part, we typically trade mostly the monthlies, and, we go out 1, 2, 3 months. Furthest we'll typically go is around 6 months. But no, if you can look at a position and say, maybe somebody reports earnings at the end of the week, and so you want to sell a really short dated call, and if it makes sense and the math works for you, then I say go for it.
Is it wise to sell a 6-month call to receive a 5 to 10% premium in the money so that it is called away early, a higher rate in a shorter time?
I'd probably have to take a look at that example specifically, but for us, because where we make our money and where I think people are more likely to have success is selling out of the money options, and those options that they decay more rapidly as you get closer to option expiry. So maybe we can include this in a future presentation, but if you look at the decay curve, these things, they really start declining in value as you get closer. So I've never been one to really play much of the game of trying to get called away early. Typically, when you get called away early, it's around a dividend payment. So what you'll see is if the time value that's left in the option is less than the dividend that's going to be coming from an ex-dividend date, that's when you'll get assigned early. So you end up in a bit of a 6 of one, half dozen of another on some of these, where you might get called away early, so you make more on your premium, but then you don't get the dividend because you don't have the stock anymore. So I'd be interested to see the strategy that you're looking at here, but that's not something that we've typically done. We typically say, look, we want to make the money on the premium. If the stock goes above that, we make a capital gain on the stock between here and then. But otherwise, maybe we're not fancy enough. We're a little too blue collar to get that going.
If the chance that the stock goes down, am I not better with a straight sell above my buy price?
Well, yeah. If the stock's 50 and you sell a 55 call, and then 2 weeks later it goes to $30, you would have been better off selling that call or selling the stock. If the challenge with that is like the lack of a crystal ball. So if anybody could see what's going to happen in the future with that underlying name, then you definitely, you'd be a trillionaire in a few weeks. What I'll say to that is that, if we have a basket of stocks, so say we've got 20 stocks in a portfolio as an example, we sell calls on 10, there's going to be the odd time that stocks go down more than you were hoping that they would. But if I sell calls on 10 names and one of them drops by quite a bit, and I would have been better off selling that stock rather than selling calls, I've got 9 other positions that, things are going the way I want them to. So the goal is that because we're doing this repeatedly, we're doing it on a broad basket, then we are going to have the little wins that we get offset any of the bigger losses. But yeah, I don't think it's a fair comparison to say, hey, should I have sold this stock instead of selling a call because it went down so much? Because if you knew the stock was going to drop that much, then this would be too easy.
Do you agree that exiting a covered call early, as in you have realized 80% with 2 weeks of a 1 month contract or 90% with 1 week to go, then you can roll early?
Yeah, so this is where covered calls and a lot of option trading, it's a combination of art and science. So there's definitely not a hard rule. That's why it's not in any textbook that says, hey, if you realize 80% of the potential gain on this in 20% of the time, then close it out. That number there is something that we kind of use. If the max gain is $2 and after 2 weeks, as you said, it's only worth 40 cents, that's something that we will potentially look at. The challenge here is to say, okay, well, what am I going to do with the stock now? So it's very rare that we would buy back the option and not have something new to replace it with, because if we just leave that option, we're going to make another 40 cents in that example. So if the stock's gone down, unless we've got something that's better or we're going to exit the position, then we'll often let it go all the way down. Where you'll sometimes see this huge compression in the option price is around an earnings. So before earnings, option prices are typically higher that occur after earnings. And then after the earnings, if the news comes out and there's nothing crazy, the stock might stay at the same level, but the implied volatility in the options will disappear. The option price will shrink. So in those situations, then we will sometimes look at it, but there is no hard rule. It's up to you. It's you to decide, hey, I already made 80% of my money in a short period of time. So yeah, I'll buy this back and move on.
Recently, there has been studies pointing out that selling covered calls cap the capital gains and alter the risk-reward prospects of the fund. They just want your point of view on that.
Yeah, I mean, that's why if you look at like the ETF space, I mean, they got something for everybody. There's funds that sell calls against 100% of the position. There's ones who sell all 10% out of the money. There's ones who sell at the money but on half the position or a quarter of the position. So I think, in our view, we implement this strategy a lot. And in our view, there will be times that you sell a call that's 10% out of the money and the stock goes up 30% in a day. And in those times you say, wow, I wish I did not sell that call. And then we'll go back and we'll take a look at, well, we sold calls on, 10 other positions in that portfolio that didn't happen. And we sold calls on this every 2 months for the last 4 years, and that didn't happen. So it's really that repetitive nature that pads that. So if you look at the math, and this will be in a textbook, is in a really bullish market where the market is rallying hard, the covered call strategy should underperform. But as long as you are picking good names and you have a modestly rising market, a flat market, or a down market, the covered call strategy should outperform. So when I talk to investors or market participants out there and they see what's happened in the market over the last 2-3 years, very few people that I talk to are like, man, we are gearing up for another 30% year. Will we have that? I have no idea. But if you are an income-oriented investor who wants to have a higher probability of making money and just maybe remove some of the home runs, you're going to have way more base hits and win a lot more often than you will otherwise. And but yeah, if the market's raging higher, this will underperform. But if you label yourself as a conservative investor, you should not outperform when the market's raging higher.
Love all the questions. Noting that we only have 5 minutes left, so we'll try to get through all of them as quickly as we can, or if we can't out of time, we'll see, Chris, if you could then follow up if they leave their full name on their questions. What parameters do you look at when buying a call? Besides the fundamentals, do you usually sell a call more than 30 days out to mitigate the risk? Do you look at the IV risk or IV or delta when buying a call?
Yeah, so when selling a call, we typically only buy calls back. I mean, sometimes if a stock is really beaten up and the options aren't too expensive, we'll look at buying a long dated call. This is not something we do a ton, but that's a whole other presentation. So I'll kind of assume that we had a mix up on buying and sell in this question. Usually we're not selling calls less than a month out, and it's usually in 1 to 3 months for the majority of them. On some of the lower volatility names or things that we've rolled a couple of times, we will look at going out to about 6 months. 6 months is about as far as we'll go. Implied volatility, that is definitely something that we keep a really keen eye on. Again, there's not pure science on this, but if we can look at a stock and say, okay, hey, the implied volatility on these options is 35, and we look back a quarter, 2 quarters, 3 years, and the realized volatility, the 30-day realized vol or historical vol, depending on what you like to call it, is only 17. Well, hey, these options are really expensive to past performance of the volatility of this name. So I want to sell that. If we look at something and say, hey, look, this thing has really wild moves in the market, and the historical volatility out the last number of periods is 40, but these options are a 22 implied vol. Well, hey, that's going to either take a little bit of extra digging for us to understand what's going on there, why these options are so cheap, or it's something that we would steer clear from. When it comes to Delta, I think Delta might be a little bit overused on deciding on which calls to sell. For us, it's more around the underlying, hey, this stock is 50. I'm okay selling it at 55, and we're getting paid a meaningful premium for that, rather than, hey, I only sell options that are a 20 Delta. You'll see sometimes, I've seen different presentations that talk about how the delta of the option is the probability that it expires in the money. I think that is a bit of a mug's game on that, and not very accurate. Especially as you move further out. I'd say something that's a 20 delta probably actually expires in the money only 10% of the time. But yeah, so implied vol we use a lot. Delta we don't really use a ton unless we're trying to sound extra smart.
I think we have time for one more. My broker does not allow put options, even if I have cash in the registered account. Then how else can we acquire shares in discount?
Yeah, so if you've got the money to do it, so if the first choice is not to fire your broker and get someone who will let you implement these strategies, you can do what's called a synthetic put. Again, that's a whole other presentation. But if you buy a stock, so you've got the money to buy it and you actually buy it, and you sell an in-the-money call option, the outcome at expiry is the same mathematically as if you had sold a put. So one strategy that people will employ in registered accounts where you cannot sell a put is to do a synthetic put, because mathematically, because we have an efficient market in here, and if there was any inefficiencies there, somebody would arb it out. So you could look at doing an in-the-money call as a put option, but that's a different presentation. You're muted, David.
How did that happen? Thanks, Chris. That's all the time we have today. On behalf of the Montreal Exchange, I want to thank Chris Tom for sharing his insights, and thank you all for joining. Just remember that a replay of today's session will be available on our website shortly. And to keep learning, please go on the Montreal Exchange website, and you can explore additional tools and also register for upcoming events. Thank you again, and have a great day.
Thank you,
everyone.